So the Federal Reserve just made its move on December 10th, cutting interest rates for the third consecutive time this year, bringing them down to a range of 3.5% to 3.75%. On the surface, this looks like good news for anyone with a mortgage, credit card debt, or thinking about buying a car. Rates are coming down, right? The Fed is helping Main Street. But here's where things get really interesting. Jerome Powell just dropped what some analysts are calling the most hawkish rate cut in recent memory, and the drama surrounding his final months as Fed chair is reaching a fever pitch. Let me walk you through what actually happened at this meeting, because the headlines don't tell you the full story. Yes, they cut rates by a quarter point. But the real bombshell came in what's called the dot plot, which is basically where Fed officials anonymously predict where interest rates will go in the future. And according to this latest dot plot, the Fed is projecting just one more rate cut in all of 2026. That's it. One single quarter point reduction next year. Compare that to what markets were expecting just a few weeks ago, when traders were betting on 2 or even 3 cuts in 2026, and you start to see why this is such a big deal. But wait, it gets even more dramatic. This wasn't even a unanimous decision. 3 Fed officials actually dissented from the rate cut, which is the highest number of dissenters at a Fed meeting since 2019. And here's the crazy part about those 3 dissenters. They didn't all disagree in the same direction. 2 of them, Chicago Fed President Austin Goolsbee and Kansas City Fed President Jeffrey Schmid, voted against cutting rates at all. They wanted to hold steady. Meanwhile, Fed Governor Stephen Moran, who's actually on unpaid leave from Trump's White House Council of Economic Advisors, dissented in the opposite direction. He wanted a bigger cut, a full half percentage point instead of just a quarter point. When you've got hawks and doves both voting against the same decision, you know there's serious division at the Fed. And Powell basically admitted as much at his press conference after the meeting. He said it was a close call, and that he could make a case for either side. That's not exactly the kind of confident, unified messaging that central banks typically like to project. Powell also said something that's going to be music to Trump's ears, whether he intended it or not. He said that the Fed is now at what they consider the high end of the range of neutral. A translation? They think they've pretty much done enough cutting for now. They're comfortable sitting back and waiting to see how the economy performs. Let's talk about why the Fed is suddenly pumping the brakes on rate cuts. Because this is where the economic data gets really interesting. Inflation is still a problem. The Fed's preferred measure, the PCE inflation index, is running at 2.9% as we end 2025, and they're projecting it will only come down to 2.4% by the end of 2026. That's still well above their 2% target. Core PCE inflation, which strips out volatile food and energy prices, is sitting at 3% right now and is expected to be at 2.5% by the end of next year. So inflation is cooling, but it's cooling slowly, too slowly for the Fed to get aggressive with rate cuts. On the flip side, the labor market has been showing some real cracks. The unemployment rate has edged up to around 4.5%, and job gains have definitely slowed throughout 2025. This is exactly what the Fed has been watching for, because remember, they have a dual mandate. They're supposed to keep both inflation low and unemployment low. Right now, they're stuck in this uncomfortable middle ground where inflation is still too high to cut rates aggressively. But unemployment is rising enough to make them worried about waiting too long. It's a tightrope walk, and Powell knows it. But here's where the political drama really kicks in, and why this meeting feels so different from previous ones. Jerome Powell's term as Fed chair ends in May 2026. That's less than 5 months away. And President Trump has made it crystal clear that he's not happy with Powell and that he's ready to replace him. In fact, Trump has already said he knows who he's picking and plans to announce his choice early next year, probably sometime in January or February. The frontrunner? Kevin Hassett, currently Trump's National Economic Council director and a longtime economic advisor who has been very vocal about wanting lower interest rates immediately. Hassett has basically been auditioning for the job in public. Just days before this Fed meeting, he went on Fox News and said he could be cutting rates right now if he were Fed chair because the data suggests that we should. He's also been extremely critical of Powell, saying there's a lot of house cleaning that needs to happen at the Fed, and that Powell made the institution look political. This is the guy who's got about 81% odds of being the next Fed chair according to prediction markets like Polymarket, and Trump has been dropping hints so obvious they might as well be billboards. At a recent White House event, Trump literally pointed to Hassett and said, "I guess a potential Fed chair is here too. He's a respected person, that I can tell you." Now, here's why this matters so much. Fed chairs are supposed to be independent. They're appointed for 4-year terms specifically so they can make decisions based on economics, not politics. But Trump has never hidden his frustration with Powell. He appointed Powell back in 2018 during his first term, and he's been complaining about him ever since, saying Powell didn't cut rates fast enough and kept them too high. Trump has literally called Powell stiff and blamed him for various economic problems. The tension has been building for years. What makes this December meeting so fascinating is that it might be Powell's last meaningful policy meeting. Sure, his term doesn't officially end until May, but Trump is expected to announce his replacement months before that, effectively creating what some analysts are calling a shadow chair situation. Bloomberg's Connor Sen tweeted that this feels like in a way the last Powell Fed meeting. Once Trump announces Hassett, or whoever the replacement is, Powell becomes a lame duck. His influence starts to wane even before he's officially out the door. And Powell knows this. When reporters asked him about the selection process at his press conference, he basically refused to comment. "I'm focused on my remaining time as chair," he said. "I haven't got anything new on that to tell you." He's trying to stay above the fray, but you can feel the awkwardness of the situation. Here's a guy trying to make critical economic decisions, while his boss's boss is publicly shopping for his replacement and criticizing him at the same time. Let's talk about what the markets think about all this, because they're telling a very different story than the Fed's dot plot. Fed officials are projecting just one cut in 2026, but futures markets are showing about a 68% probability of 2 or more cuts next year. That's a massive disconnect. Traders are basically saying, "We don't believe you, Fed. We think you're going to have to cut more than you're admitting." This kind of divergence between Fed projections and market expectations usually means somebody's going to be wrong, and it creates volatility. Stocks actually rallied after the Fed decision, with the Dow jumping 500 points. The S&P 500 closed just off its record high. But that positive reaction is interesting because it suggests investors think lower rates are still coming despite what Powell said. Treasury yields actually fell, which typically happens when people expect more rate cuts ahead. It's like the market is looking past Powell and already pricing in a more dovish Fed under new leadership. Here's something else that happened at this meeting that didn't get as much attention but is actually pretty significant. The Fed announced it's going to start buying Treasury securities again. They're starting with $40 billion in Treasury bills this Friday, and they said purchases will remain elevated for a few months before tapering off. This is a reversal from their previous policy of letting their balance sheet shrink. Powell explained this by saying that reserve balances have declined to ample levels, and they need to maintain enough reserves in the system. But think about the timing of this. Just as Powell is signaling fewer rate cuts ahead, he's also announcing the Fed will pump $40 billion into the Treasury market. It's a way of keeping financial conditions loose even while talking tough on rate cuts. Some analysts see this as Powell trying to thread the needle, acknowledging inflation concerns while still providing some support to the economy. Others see it as the Fed hedging its bets because they're genuinely uncertain about what's coming next. And they should be uncertain because 2026 is shaping up to be an absolute wildcard for the economy. The Fed is projecting GDP growth of 2.3% next year, which is actually pretty healthy. They bumped that up from their September estimate of just 1.8%, so they're more optimistic about growth. But at the same time, they're projecting unemployment will stay at 4.4%, and inflation will only slowly drift down to 2.4%. That's what economists call a Goldilocks scenario, growth without overheating. But is it realistic? Here's what could throw all these projections out the window: Trump's tariff policies. The administration has already implemented significant tariffs, and more could be coming. Powell was asked about this at his press conference, and he was very careful with his words. He acknowledged that tariffs will likely cause at least a temporary increase in inflation, and could be more persistent, depending on their magnitude. But he also said the Fed is well placed to wait and see how that turns out. In other words, we're going to watch and hope for the best. The problem is, if tariffs do cause a sustained spike in inflation, that puts the Fed in an even tougher spot. Do they keep cutting rates to support employment, or do they hold rates higher to fight inflation? This is exactly the kind of scenario that creates what's called stagflation, where you get high inflation and high unemployment at the same time. It's an economic nightmare that the Fed hasn't had to deal with since the 1970s. And here's where Kevin Hassett's potential appointment becomes really important. Multiple economists have raised concerns about what might happen if Trump installs a loyalist at the Fed, who is more focused on pleasing the president than making independent economic decisions. Justin Wolfers, an economist at the University of Michigan, pointed to Turkey as a cautionary tale. He said, when Turkey's president pressured the central bank to keep cutting rates even as inflation was accelerating, it led to inflation hitting 80%. Now, that's an extreme example, and the U.S. has much stronger institutions, but the warning is real. Central bank independence matters. Here's the thing, though. Not everyone is convinced Hassett would be a disaster. Michael Pierce, chief U.S. economist at Oxford Economics, told reporters that while there's a risk Hassett could be seen as too political by other Fed officials, which might reduce his influence, a lot of the fears are overblown. He points out that Hassett would still need Senate confirmation, and once appointed, he'd be accountable to bipartisan congressional committees. There are checks and balances in the system. But here's what we know about Hassett's views. He's been consistently dovish, meaning he favors lower rates. He criticized the Fed for being too slow to cut rates and for losing control of inflation in the wake of the pandemic. He's a big supporter of Trump's economic agenda, including tax cuts and tariffs, even though he's acknowledged in the past that tariffs can have negative economic effects. He's also suggested that the Fed building renovation costs could constitute grounds for firing Powell, which shows he's willing to find creative reasons to support Trump's wishes. The interesting thing is that a CNBC Fed survey showed that while 84% of respondents think Trump will pick Hassett, only 11% think he should be the pick. The preferred choice among economists? Current Fed Governor Christopher Waller, with 47% support. Waller is seen as more technically competent and less political. But Trump doesn't seem to care what economists think. He cares about loyalty and whether his Fed chair will do what he wants. Let's talk about what this all means for regular people watching at home. If you've got a mortgage, you might see some modest relief over the next year, but don't expect a dramatic drop in rates. That single quarter point cut the Fed is projecting for 2026 might bring mortgage rates down a bit, but we're not going back to the ultra-low rates of the pandemic era anytime soon. The average 30-year fixed mortgage rate was 6.19% last week, down from its peak, but still elevated compared to recent history. If you're saving money in a high-yield savings account or money market fund, your returns are probably going to stay relatively attractive through 2026. Those accounts closely track the Fed funds rate, and with rates likely staying above 3%, you're still earning decent interest on your cash. That's actually a good thing for savers who got crushed during the years of near zero rates. For the stock market, the outlook is mixed. Historically, stocks do well when the Fed is cutting rates in a non-recession environment, and right now, we're not in a recession. UBS noted that since 1970, the S&P 500 has averaged a 15% annual return during periods when the Fed cuts rates, but the economy is in recession. So that's bullish, but there are concerns about valuations, particularly in tech stocks. About 90% of survey respondents think AI stocks are overvalued right now, which is up from 79% just a few months ago. The big question everyone's asking is whether Powell will stick around after his term as chair ends in May. Legally, he could remain on the board of governors until January of 2028, even if he's not reappointed as chair. Past Fed chairs have typically left when their leadership term ended, but Powell has kept his options open, which is unusual. Given the unprecedented pressure he's faced from Trump, some analysts think he might stay on the board just to provide some institutional continuity and act as a counterweight to a more politically minded chair. Here's what's going to happen over the next few months. Trump will announce his pick for Fed chair, probably in January or February 2026. That person will need Senate confirmation, which could take a few weeks or months depending on how controversial the pick is. If it's Hassett, expect some tough questions about his independence and his views on monetary policy. Powell will continue as chair through May, but his influence will diminish once the replacement is named. The new chair will then face their first real test at the June FOMC meeting, where they'll have to navigate all the competing pressures we've talked about. Inflation that's still above target, an unemployment rate that's rising but not catastrophic, Trump pushing for lower rates, and markets that are already pricing in their own expectations. It's going to be fascinating to watch. One more thing worth mentioning, the Fed's credibility is really on the line here. For decades, the Fed has been seen as one of the most independent and respected central banks in the world. That independence has allowed them to make tough decisions without political interference, which has contributed to relatively stable inflation and economic growth over the long term. If that independence gets compromised, if the Fed becomes seen as just another political tool of whoever's in the White House, that's when you start to see real problems. Markets lose confidence, inflation expectations become unanchored, and economic volatility increases. So yeah, the Fed cut rates by a quarter point this week, but that's almost the least interesting part of the story. What we're really watching is the twilight of the Powell era and the beginning of what could be a very different Fed under new leadership. The dot plot showing only one cut next year is Powell's way of saying the Fed is not going to go crazy with easing. But will his successor stick to that view, or will they bend to political pressure? That's the multi-trillion-dollar question as we head into 2026. The next few months are going to be absolutely critical for U.S. monetary policy and the broader economy. Keep your eyes on three things: Trump's announcement of his Fed chair pick, how markets react to that announcement, and what happens with inflation data in early 2026. If inflation stays stubborn or even ticks higher because of tariffs, all bets are off. The Fed might not cut at all, or they might feel pressured to cut anyway and deal with the consequences later. One thing's for sure, though. Powell's December 10th meeting, with its conflicted vote, its cautious dot plot, and its awkward press conference, feels like the end of an era. And whatever comes next, it's going to be very, very different from what we've seen.